Hey, Jonathan Williams back again from the Bricks and Mortar podcast. Last one we did on this, we talked about affordability, didn't we? And what I was saying to you was that in the mortgage side of things, then you're looking at three things that you need to do. So you're looking at affordability, you're looking at decision in principle and application. So let's talk about decision in principle. What is the decision in principle? Well, in essence, the decision in principle is pretty much a glorified affordability check. They will still go through the same checks that you would go through as far as an affordability check is concerned. So first things first, you're going to look at your employment. So they'll dig a wee bit deeper as far as the employment is concerned. They will look at your income, your employer, just do a wee bit more of background as far as information is concerned. They want to know where you stay, okay? They want to check to make sure that you're on the electoral roll. So they'll also want to make sure that you've been living in the property that you're saying that you're living in. They will be looking for at least 3 years occupancy there. And if you don't have 3 years occupancy there, then you'll need to supply that. So that's something to think about. So that's income, that is where you stay, your address. They'll again dive a bit deeper in as far as your expenditure is concerned. They'll probably ask you about council tax, they'll ask you about buildings insurance. A lot of the lenders will look at a decision in principle as far as that is concerned. And also what they will do is they will look at your expenditure with regards to unsecured loans, and they will want specifics as to how much you've got outstanding, how much you still have to pay, your monthly expenditure as far as these things are concerned. You then press the button, and what the difference is with regards to the difference between an affordability check and the decision in principle is all to do with the credit score. So let's dive a wee bit deeper as far as the credit score is concerned. They will run a credit check on you. So the first thing to know is, can you afford the mortgage? Okay, so once you've gone over that hurdle, they want to see, have you got a history? Have you been able to create a history that says to the lender, that gives the lender some comfort that you were a good bet to pay the mortgage on a regular basis? So really what they're looking for is a good credit file. We talk about credit files a lot when we're advising clients on mortgages, and the credit file is really supplied from one of two sources. One is Experian and one is Equifax. You will have probably seen on the TV the Experian reports about somebody stuffing a cushion and making sure, and it's a numbered cushion, and what they're trying to do is to increase your credit score. So your Experian credit score, you can probably download a free 30-day trial, no cost for that. Not too sure about Equifax, but an Experian report is based out of 999. That's the absolute tops. And in Equifax, you're looking at a score that is in excess of 500. I think the British average is 380. But if you can get a score sort of high 400s, then you're pretty much home and hosed as far as a mortgage is concerned. So the credit score will take into account and will take a snapshot of all your credit liabilities. So it will tell a broker, what current account you've got. Have you got any credit cards? And it also will tell me whether or not you've got any unsecured credit. And not only will it tell me that, it will also tell me what your payment history has been. And that is the absolute crux that a lender is looking for. They want to see that you've got credit out over a significant period of time and you've been able to pay that on a monthly basis. I'll come to the issues about credit score a wee bit later on, but suffice to say that if you make sure and pay all of your credit commitments on time, then you shouldn't have a problem. and you should sail through the decision in principle. Now, the decision in principle will leave a footprint. Every time you do a decision in principle, it will leave a footprint on your credit file. And if you have too many footprints on your credit file, that will reduce your score. There are a number of other things that will reduce your score, obviously. They are as follows. If you default, that means you don't pay your credit commitments. Then how can you expect your credit score to remain constant? If you take a payday loan, that's not going to be great. If you're sequestrated or have to liquidate a business, that's not going to reflect very well on your credit score. And if you're not on the electoral roll, these things will all have a negative bearing on the figure. And it's the figure that you've got to look after, because ultimately, if you can afford the mortgage, you might not be able to pass muster as far as the credit score is concerned. So for goodness sake, you need to look after the credit score. Okay? So we've touched on affordability in the last one. We've given you a wee bit more information there about the decision in principle. Credit score is absolutely vital. But you don't want to be doing too many decisions in principle. Let me give you some examples as to what can affect, what things clients have done that have meant that they don't pass a decision in principle. You would normally think, gosh, they've got to be large issues, like 4 or 5 defaults, or they've got a county court judgment against them, or they've taken lots of payday loans. But there are some lenders out there that if you have missed a mobile bill payment of £10 4 years ago, there are lenders out there who will fail you on the decision in principle. Now that's not a disaster, because in many respects you can appeal these decisions. But if you haven't got a proper story as to why you have missed these payments, then your decision in principle will not be appealable, and it will have left a footprint on your credit score, which is the last thing that you want. Some clients of mine, they will ask me, well, why is it that numerous decisions in principle will leave footprints on your credit score, which will bring your credit score down? Because a lot of people, I think, want to look at maybe 3 or 4 different lenders, chew the fat with the 3 or 4 different lenders, know that they've got to a stage and that they've got a decision in principle with 2 or 3 lenders, and then choose which product they want. But the banks and building societies don't see it that way. What they see is that if you go from one request for a decision in principle to another, they just think that you've been refused the first one, refused the second one, and so on and so on. So that's the reason why the banks and building societies are not keen on you doing too many decisions in principle. So listen, next time round what we're going to talk about is the application. Once you've got through the decision in principle, it will then go to full application, and then we're on to the underwriting process. But most of the time, once you've got a decision in principle, you should, all things being equal, get your mortgage soon after. Listen, I'm Jonathan Williams, Bricks and Mortar Podcast. It's a sideways look at property.